Unanimity is the name of the game today. Next guests are unanimous in their view that the first cut in interest rates will not come until the summer, and that Jay Powell will want the committee to be as close as unanimous as possible before that cut is actually delivered. Let's bring in Julia Coronado, joins us on the phone, Macropolicy Perspectives president and founder, Subadra Rajappa, head of U.S. rate strategy at Societe Generale, and David Bailin, Citi Global Wealth CIO. Welcome to all of you. Subadra, let me begin with you and just get your sort of baseline view of what's going to happen today. And then what would be your outlier view? In other words, if the baseline doesn't come through, what would your next alternative be?
Yeah, so like Steve was mentioning, I think that the Fed might upgrade its growth forecast as well as its maybe a tick higher on inflation for this year. But really, the focus is going to be very much on the dot plot. So we're expecting that the Fed retains 3 cuts for this year. Our call is that the Fed will deliver the first cut at the June meeting and then stick to a 1 cut per quarter schedule for the remainder of the year. But really, the surprise for us will come if they move the dot for 2024 to suggest only 2 cuts for this year. And there's also a chance that both 2025 as well as the long-run dot gets pushed higher. So that, to us, would suggest that the Fed is looking at perhaps a higher trajectory, a higher terminal Fed funds rate. And that, I think, would be a clear hawkish signal that the Fed is sending to the markets. And that, in turn, I think, would push Treasury yields higher.
Let me turn that same question to you, David, and ask you what your baseline scenario is. And do you agree with Subadra that the possibility is a more hawkish tilt?
Well, I think the only place where I would take issue with that view would be, I think, first of all, the Fed may start, one meeting later. Once they start, I think it's more likely than not that they're going to have a series of cuts. Right now, everyone's expecting 3. That's sort of the average, right, of what people's views are. Once they begin to cut, having a regular systematic approach, a sort of baseline of 25 basis point cuts this year and beginning of next year, I think is more likely than not as a baseline because they want to normalize their policy. The Fed tends to be an activist group. They tend to look at all the data from time to time. But once they get going, right, they want to be in a direction, right, where they actually begin, to normalize the curve and to normalize policy associated with buying back bonds, right, ending a portion of QT. Then the outlier scenario for us is the other way, which is the economy actually weakens more than we expect in the area of employment. And with that, I think we would see the Fed move a little more aggressively in terms of the amount that they might, decrease rates at one of those subsequent meetings. So we tend to lean that way because ultimately the Fed's higher rates and QT, is ultimately going to be a break on the economy. It's been wildly resilient so far. But when that break happens, the question is, does it happen gently or do we see an actual more sustained decline in employment?
All right, Julia, let me turn to you and get your sort of baseline thought here. And if the Fed turns out to be a little bit more hawkish than we anticipate, what do you expect the economic response would be in terms of inflation and growth and unemployment? And what do you think the market's response would be?
Right. Yeah, that's a great question. So I think we all share a similar baseline that they'll keep it largely unchanged, but the risk is that they'll take a cut out. One of the conversations that's happening in markets and at the central bank is whether potential growth might be a little bit higher this cycle because of immigration, because of better productivity. That might signal a higher, longer run rate, and or it might lead them to take a cut out of not this year, but next year. So I think there's maybe an intent to balance the risks here by keeping the current baseline unchanged. Nobody thinks the neutral rate is 5.5%. Inflation's coming down. They're going to start the cutting cycle, but they're going to proceed carefully and cautiously, again, outside a deterioration in employment. They can proceed to be careful and thoughtful, as Chair Powell indicated, but they don't necessarily want to delay forever because the longer you stay at this rate, the greater the risks are for that sudden turn that David just described.